View on the markets now. We have Devina Mehra, who's the founder, chairperson and managing director at First Global, joining in to discuss the markets and the outlook for 2024. Devina, always a pleasure to listen to your views. Wishing you a very happy new year and good to see you here. Not to mention all of your tweets that, I keep reading. And one of them that stood out was your report, which you wrote on HDFC Bank around 30 years ago. Tell us more. Let's start the conversation with the financial space. Your view, one, on HDFC Bank. Would you be a buyer at current levels? And two, whether financials are actually going to lead this year.
Good afternoon and a very happy new year to you and to your viewers also. So since you started with financials, I am... some people tell me that in every interview you repeat this line that I'm always a nervous investor in banks and lenders, and simply because in banks you're more likely to get negative surprises than positive surprises. So yes, I mean, HDFC Bank in 1996 was a landmark call for us, and there was a lot of logic behind that. But in general, I am a wary investor in banks. And if you look at the banking space itself in the last 4 years, if you look from 2020 to 2023, there's been only 1 year when banks have outperformed. The bank Nifty has outperformed the Nifty only in 2022. And that was the only year where we were market weight to overweight on banks. So if you look at 2020, banking was the only major sector index in the negative. In 2021, the market went up 22%, Bank Nifty only 11%. Only in 2022, it had a substantial outperformance. 2023, again, only half as much as the market, or probably a little less. So if you look at kind of a non-bank Nifty, the net of the banking stocks, the underperformance would have been even higher. So, I mean, only in 2022, you had a kind of sweet spot where NPA cycle was behind you and the credit growth was good. And plus, when interest rates go up in the beginning, that is good for banks' margins. But now, again, things are not looking so clear on credit quality and all that. To the extent we are quite underweight banks. And to the extent we have banks, it's a little more skewed towards the PSU banks. But of course, I mean, we do hold banks because that is the number one. Banking and lenders together are the number one weight in the Nifty. So you can't ignore them completely, but we are quite underweight. And that our systems don't really like the sector, I can say.
Okay, all right. Hi, Devina, and welcome to the show, and wishing you well for 2024. Looking forward to being in touch all through the year. Well, tell us, Devina, so on the banks, I think you'll have cut down exposure a little bit. But what would be the top two sectors you're looking at from here on as well? I understand, I think pharma is something that you're looking at, maybe industrials as well. They still have some juice left in it. Spell out those two top sectors.
Okay, so industrials, most people discovered in 2023. We've been actually overweight industrials since October 2021. So much over 2 years now. And the question we ask every quarter is that, is the story over? Till now, our systems have not signaled that the story is over. Of course, we have cut from the peak, we booked profits and so on, but we still remain quite overweight. In 2023, yes, we added pharma. We also added auto and auto components. Both these sectors did well for 2023, and we still remain overweight there. We added a few construction companies also. So sectorally, those would be the broad overweight calls we have.
Devina, hi, season's greetings, and very happy new year to you and your team as well. May it be a good year for all of us. So, we're coming to start this year with this perfect narrative on, falling rates, rising earnings, predicted continuity, when it comes to politics. I'm just wondering then, what should the approach be, overall approach be to the portfolio? I mean, last year, CapEx and industrials and PSUs, that was a big theme. FMCG underperformed. Are you expecting that setup to continue, or could we have some dark horses? And overall, what are you penciling in for the market if you try and crystal ball gaze into it?
Yeah, so I've already told you the sectors that we like, so that, but of course, not everything holds for 1 year. So we really look at things from scratch every quarter. So every quarter the question we ask ourselves is that if we had cash today, where would we be invested? So we don't like to be weighed down by what we did in the past. So that's the question. And we like to be fairly diversified. So I've already told you where we are overweight. In terms of where caution is advised, I would say there's been a lot of euphoria last year on the small cap, micro cap, and small cap indices, depending on which one you look at, are up between 45 and 55%. So that's the area where some caution is advised for, especially for new investors who don't have an idea of the history of the market, that in 2008-9, the small cap index, not just the stocks, fell nearly 80%, 78% to be exact. And there was about a year and a half bull run in 2017-18, and thereafter again there was a nearly 2/3 fall. So all these narratives of this has been the CAGR in 2 years and 3 years. Let me just tell you that if something falls 65%, it can triple and you will still be at zero. And in small caps, the risk often becomes that it is not even that you will get that price back, because many of those stocks just disappear. So, I mean, currently there are about 4,000 stocks that are actively listed, whereas many times more have been listed have had IPOs in the history of the market. So many stocks just disappear. So the same kind of risk management that works for large caps with stop losses, etc., doesn't necessarily work for small caps, because the stock can just fall and you may not even be able to exit. So caution is advised there. Among the major sectors, as I said, we don't really like banks. On the consumption themes, our systems have not signaled anything great. I mean, there might be an odd stock here and there, because sector calls and stock calls are different. Like in 2023, our number one performer in our PMS is a IT company. Whereas the IT as a whole may not have done that well. So not everything is a sector call, but sectorally, those are the broadly what our systems are telling us.
Sure. Just to take that point on sectors forward, since you mentioned that you like industrials, and overall, I mean, you're also advising caution on some of the smaller names. Can you expand on that? Because again, this is a part of the market that's run up very hard, and we're talking about putting incremental, fresh money to work here. So within industrials, I mean, are you looking at only the biggest blue chip names like the ABB Siemens of the world, or mid-cap names, or, would you look at a conglomerate like L&T? What should one look at more specifically within industrials this year, given the rally?
So, I mean, we do have mid-caps also, but overall, I'm not talking, I mean, I would not even have the data immediately as far as what the split within industrials is. That, but I can tell you that stocks, we don't look at stocks below 1,000 crore market cap in any case. I'm talking overall, not just industrials. And even within 1,000 to 5,000 crore market cap, we would normally not have more than 15-20% of our weightage there. Currently, it might be around 15. I think maximum we've ever gone to is 22. So those are to manage the risks. And as I said, we don't take very outsized sector exposure also. So our sectoral distribution is also quite wide. So we are not going, even if we like a sector, we're never going to be 40% of our PMS in that sector. So that's what we like to do. I mean, the individuals, but beyond that, as I said, individual stocks have to be looked at. Like, for example, this year, as I said, top performer was an IT company. In previous years, among our top 5 have been, for example, ITC and Raymond's, neither of which were sector calls. So the sector is for us more an outcome of the stocks that our systems like, but we like to have that sector overlay only to the extent that we don't want overexposure to a single sector. All part of our risk management. So we always say that you pay 60% of the fees for risk management and only the balance for return management, because investing is a loser's game. So do not lose big money. That's the first mantra.
Okay, all right, Devina, we're going to let you go on that point. And thanks very much for joining in. That caution with regards to the small caps is definitely warranted, considering that the Nifty Small Cap 250 Index has rallied 43% in FY24 year to date. So that is something to take note of.